I read the first 122 pages of the Fisker 10K. The rest are notes. And this video is designed to highlight what I thought was interesting about those 122 pages. It's not a summary, it's not a synopsis, and it's not an analysis, because there are no opinions or conclusions drawn in this video at all. It is just my personal opinion of what I thought was interesting within this statement. If you don't want to read the whole thing, and you want a general idea of what's happening from a consumer standpoint, this is the video for you. On page 1, forward-looking statements in this report may include, for example, statements about our ability to continue as a going concern, our ability to grow and manage growth profitably, our ability to enter into additional manufacturing and other contracts with Magna, OEMs, or Tier 1 suppliers in order to execute our business plan, our ability to execute our business model, including market acceptance of our planned products and services, our expansion plans and opportunities, our expectations regarding future expenditures, our ability to raise capital in the future, our ability to attract and retain qualified employees and key personnel, the possibility that we may be adversely affected by other economic, business, or competitive factors, changes in applicable laws or regulations, the outcome of any known or unknown litigation and regulatory proceedings, our transition to a dealer partnership model, and other factors described in this report, including those described in the section entitled Risk Factors under Part 1, Item 1A of this report. Page 3, Item 1. The following discussion contains forward-looking statements that reflect future plans, estimates, beliefs, and expected performance. Once again, it refers to risk factors in Item 1A, which we will definitely cover. On page 5, Magna collaboration. We entered into a cooperation agreement with Magna, an industry-leading supplier and manufacturer of premium high-quality vehicles. The cooperation agreement sets out the main terms and conditions for certain operational agreements related to manufacturing, engineering, component sourcing, and manufacturing for the Fisker Ocean. By working with an established contract manufacturer, such as Magna Steyr, we accelerated our time to market, reduced risk for quality vehicle assembly, and gained access to an established global supply chain. We previously entered into a non-exclusive car platform sharing agreement with a Magna subsidiary, and while this agreement remains in place, we have substantially re-engineered an original platform proposal with the Fisker-owned FM29 platform, which we have the right to commercialize accordingly. Fisker EV platforms. We created FM29, a unique EV platform that has unique Fisker intellectual property. Our proprietary FFPAD process is hardware agnostic, which will enable us to collaborate with multiple suppliers for development of new, advanced EV platforms. Fisker FM29 platform is a premium crossover SUV platform developed for global markets that we are exploring to adapt into other derivatives, such as a pickup truck FT32, Project Alaska/Kayak. SLV1 Project Pear is a brand new cost-efficient platform which we plan to adapt into other potential derivatives. A third platform is conceptualized, Project Ronin, for high-end luxury vehicles at low volumes. Page 6, in the middle of this paragraph, entitled Reimagine the Customer Experience for Personal Transportation and Car Ownership, states, we are designing our EVs to be compliant with the CCS standard and adoption of the NACS standard in North America, where we have already signed an agreement with Tesla that will allow all Fisker Ocean owners in North America to use the Tesla charging network by January 1st, 2025. This will allow our vehicles to charge with existing public charging infrastructure in North America. We have executed charging network agreements with ChargePoint in North America and Deft Power in Europe. We've entered into an agreement with ChargePoint and their roaming partners who are committed to utilizing renewable energy for their charging stations. On page 10, under Service Marketing and Insurance. In 2024, we plan to increase our marketing budget as we roll out our new dealer partnership model, while decreasing our internal spending through the elimination of costs associated with the direct-to-consumer business model. We plan to continue to expand our social media presence as a key part of our marketing efforts. We plan to attend and participate in global events and to activate pop-up showrooms to give customers the opportunity to experience Fisker vehicles. We support our customers by providing reference to reputable available third-party automotive insurance options. On page 11, under Direct Sales, Service, and Vehicle Financing, during 2024, we will be transitioning to a dealer model from a direct-to-consumer model, but expect to operate under both models during 2024. Europe will operate under both models. Underneath of the win-win-win diagram, Fisker dealers will provide retail, service, test drive, and delivery functions for Fisker vehicles. Fisker dealers will be able to open at a faster pace due to the lower amounts of upfront capital investment versus traditional dealer strategies employed by other OEMs. Vehicle maintenance. In each case, we will be alerted by either the vehicle's onboard diagnostics or the customer, and we will then refer the customer to their nearest Fisker dealership. On page 14, intellectual property. As of March 6th, 2024, we owned 16 issued U.S. patents. We have 56 pending or allowed U.S. patent applications, 51 issued foreign designs, and 16 pending foreign design applications. In addition, we have 162 registered trademarks and 13 pending trademark applications. Our patents and patent applications are directed to, among other things, vehicle design, engineering, and battery technology. On page 17, on January 11th, 2024, NHTSA opened a preliminary evaluation regarding the Ocean's braking performance. On February 14th, 2024, NHTSA opened a preliminary evaluation regarding the alleged unintended movement. And on April 1st, 2024, NHTSA opened a preliminary evaluation regarding alleged failure of the Ocean's latch and handle that prevents the doors from opening. The company is fully cooperating with NHTSA with respect to these matters. On page 18, under Human Capital Resources, as of April 19th, 2024, we employed approximately 1,135 employees. The decrease since December 31st, 2023 primarily reflects actions taken to reduce our headcount. Item 1A, risk factors, starts on page 19, and the risks are broken down in bullet points, and then in an entire other section lower down, the bullet points have more detail. So I'm going to skip to the part with the detail. Operational risks. There is substantial doubt about our ability to continue as a going concern. We used $904.9 million in cash in operating and investing activities in 2023, and our cash balance reduced from $736 million in December 2022 to $325 million at December 31st, 2023. Our cash and cash equivalents balance further reduced to $53.9 million of unrestricted and $11.2 million of restricted cash at April 16th, 2024, reflecting significant payments to certain suppliers. We expect to require additional cash in 2024 for debt service and investment needs, and our ability to generate cash from operating activities will depend on our ability to transition to a dealer model and sell vehicles. Accordingly, we have concluded there is substantial doubt as to our ability to continue as a going concern. Moreover, if we do not raise capital in the near term or receive a forbearance agreement and/or waivers from our debt holders for relief from current defaults, we will be unable to satisfy our debt service obligations and expect to seek protection under applicable bankruptcy laws. On page 24, there are complex software and technology systems that need to be developed in coordination with vendors and suppliers in order to reach production for our electric vehicles. And there can be no assurance such systems will be successfully developed. Couple more operational risks to highlight on page 28. We are highly dependent on the services of Henrik Fisker, our Chief Executive Officer, and, together with his wife, our Chief Financial Officer, our largest shareholder. Mr. Fisker is the source of many, if not most, of the ideas and execution driving Fisker. If Mr. Fisker were to discontinue his service due to death, disability, or any other reason, we would be significantly disadvantaged. And just 2 pages later, on page 30, our management has limited experience in operating a public company. Our executive officers have limited experience in the management of a publicly traded company. Their limited experience in dealing with the increasingly complex laws pertaining to public companies could be a significant disadvantage in that it is likely that an increasing amount of their time may be devoted to these activities, which will result in less time being devoted to the management and growth of the combined company. The development and implementation of the standards and controls necessary for the combined company to achieve the level of accounting standards standards required of a public company in the United States may require costs greater than expected. It is possible that we will be required to expand our employee base and hire additional employees to support our operations as a public company, which will increase our operating costs in future periods. The next section is macroeconomic, market, and strategic risks, which there are many, but the first one I'd like to highlight is on page 34. Our dual-class structure may depress the trading price of our Class A common stock. We'll get deeper into that one later. Next, Henrik Fisker and Dr. Geeta Gupta Fisker are married to each other. The separation or divorce of the couple in the future could adversely affect our business. And finally, on page 34, we have identified material weakness in our internal control over financial reporting. If our remediation of such material weakness is not effective, or if we experience additional material weaknesses in the future or otherwise fail to develop and maintain effective internal control over financial reporting, our ability to produce timely and accurate financial statements or comply with applicable laws and regulations could be impaired, which could adversely affect investor confidence in the accuracy and completeness of our financial statements and adversely affect our business and operating results and the market price for our Class A common stock. On page 35, the issuance of shares of our Class A common stock upon the conversion of the 2025 notes or the exercise of the outstanding Magnum warrants would increase the number of shares eligible for future resale in the public market and result in dilution to our stockholders. At the bottom of page 35 is the beginning of the financial risks. The first of which I'd like to highlight is on page 37. Insufficient warranty reserves to cover future warranty claims could materially adversely affect our business, prospects, financial condition, and operating results. Also on page 37, absent relief, as a result of our failure to timely file a periodic report with the SEC, we are currently ineligible to file a registration statement on Form S-3, which is likely to impair our ability to raise capital on terms favorable to us in a timely manner or at all. And in the subsequent paragraphs, it summarizes that Form S-3 is an expedited way to access capital markets, but is only available to companies in compliance with the SEC. Fisker would be forced to use Form S-1, requiring proposed offering and material terms thereof before any offering commences. And then the SEC would have to do a potential review. Page 38 lists the potential risks of being traded on the over-the-counter market, including the fact that it's a limited market, is less regulated, and may be subject to abuses and volatility. Next is legal and regulatory risks, which I hate to call straightforward, but these are all fairly consistent with what any company would go through, except this one on page 43. Shares of our Class B common stock have 10 votes per share, while shares of our Class A common stock have 1 vote per share. Henrik Fisker and Dr. Geeta Gupta Fisker, Fisker's co-founders, members of our board of directors and chief executive officer and chief financial officer, respectively, hold all of the issued and outstanding shares of our Class B common stock. Mr. Fisker and Dr. Gupta Fisker may have interests that differ from other stockholders. This may have the effect of delaying, preventing, or deterring a change in control of Fisker. Could deprive its stockholders of an opportunity to receive a premium for their capital stock as part of the sale of Fisker, and might ultimately affect the market price of shares of our Class A common stock. The next section is risk to our convertible senior notes, which I will actually refer to the bullet points earlier in the document as to simplify the complexity of these notes and their obligation. From page 21, the 2026 notes are effectively subordinated to our existing and future secured indebtedness and structurally subordinated to the liabilities of our subsidiaries. We did not make a required interest payment of approximately $8.4 million payable in cash on March 15th, 2024, with respect to the 2026 notes. Under the indenture governing the 2026 notes, such non-payment is a default, and we had a 30-day grace period to make the interest payment, which now has elapsed. Such non-payment constitutes an event of default with respect to the 2026 notes. For the quarter ended March 31st, 2024, the 2026 notes, in addition to the 2025 notes, are expected to be classified as a current liability. We may be unable to raise the funds necessary to repurchase the 2026 notes for cash following a fundamental change as defined in the indenture, or to pay any cash amounts due upon conversion, and our other indebtedness limits our ability to repurchase the 2026 notes or pay cash upon their conversion. Our indebtedness and liabilities could limit the cash flow available for our operations, expose us to risks that could adversely affect our business, financial condition, and results of operations, and impair our ability to satisfy our obligations under the notes. Our obligations to the investor pursuant to the 2025 notes are secured by a first priority security interest in all of the existing future assets of the company and certain of our subsidiaries, and because of a default, the investor could foreclose on, liquidate, and or take possession of such assets. If that were to happen, we would be forced to curtail or even cease our operations. On page 50, we are a party to a forbearance agreement which expires on May 1st, 2024, unless extended by the investor, and if we are unable to comply with the forbearance agreement, then the investor could require us to immediately repay the amounts due under the 2025 notes. And that's all I want to report on for risks. Keep in mind, I didn't even scratch the surface on the number of risks actually listed, but those were the ones that were the most interesting to me. That was item 1A. Item 2 is properties. On page 53, our corporate headquarters are located in Manhattan Beach, California. The lease will terminate on November 1st, 2026, with no option to extend the lease term. We believe our existing facilities are adequate for our current requirements. We also believe we will be able to obtain additional or alternative space at other locations at commercially reasonable terms to support our continuing expansion. Legal proceedings. For a description of material pending legal proceedings, please see Note 19, Commitments and Contingencies, to the consolidated financial statements included elsewhere in this annual report, which we will move to now. From page 109, the second paragraph states a punitive class action lawsuit is pending against the company in the United States District Court for the Central District of California that alleges claims under the federal securities laws, including that the company made false and or misleading statements and or omissions concerning operations, prospects, and internal control over financial reporting. The company is currently unable to estimate any reasonably possible material loss or range of loss that may result from this action. On page 54, item 5 goes through the delisting. Next is the financial statements, which I will simply include screenshots of. Once again, the most interesting thing here is on page 64, which reiterates that cash and cash equivalents net of restricted cash is $53.9 million as of April 16th. On page 71, report of independent registered public accounting firm. The accompanying consolidated financial statements have been prepared assuming that the company will continue as a going concern. The company, among other things, did not make a required interest payment in March 2024, which resulted in events of default, and does not believe that its available liquidity will be sufficient to meet its current obligations for a period of at least 12 months from the date of issuance of the financial statements. If unsuccessful in the management's plan, the company expects to seek protection under applicable bankruptcy laws. The consolidated financial statements do not include any adjustments that might result from the outcome of these uncertainties. On page 72, definition and limitations of internal control over financial reporting. Because of its inherent limitations, internal control over financial reporting may not prevent or detect misstatements. Also, projections of any evaluation of effectiveness to future periods are subject to the risk that controls may become inadequate because of changes in conditions, or that the degree of compliance with the policies or procedures may deteriorate. As described in notes 2 and 4 to the consolidated financial statements as of December 31st, 2023, the company's inventory balance was $406.5 million. Inventories are stated at the lower of cost or net realizable value and consist of raw materials, work in progress, and finished goods. Inventory is determined using standard cost, which approximates actual cost to a first-in, first-out basis. For the year ended December 31st, 2023, the company recorded a write-down of total inventory to net realizable value totaling $232.7 million. As disclosed by management, inventory is reviewed by management to determine whether its carrying value exceeds its net realizable value upon the ultimate sale of the inventory. This requires management to determine the selling price of the vehicles, less the estimated cost to convert the inventory on hand into a finished product. On page 73, under Accounting for Revenue, as described in Note 2 of the consolidated statements for the year ended December 31st, 2023, the company recognized revenues of $272.9 million. The company's revenue is primarily generated from the sale of electric vehicles and accessories to customers, as well as specific services provided that meet the definition of performance obligation under ASC 606, revenue from contracts with customers, including over-the-air software updates as they become available, premium connectivity, roadside assistance, service packages, specified vehicle upgrades, and charging station benefits. My next notable observation comes from page 81, under warranties. The company provides a basic 6-year manufacturer's warranty on all vehicles sold that covers the costs to repair or replace faulty parts or components, including those costs incurred under recalls. The company records a warranty reserve based on industry benchmarks and/or actual claims incurred to date and after consideration of the nature, frequency, and costs of future claims. The warranty does not cover any item where failure is due to normal wear and tear. The assurance type warranty does not create a performance obligation as part of the sale of the vehicle. The amount of warranty claims is included within the accrued expenses and other in the consolidated balance sheets. The warranty expense is recorded as a component of cost of goods sold in the consolidated statements of operations. On page 86, advertising expense. Advertising costs are expensed as incurred and included in selling, general, and administrative expenses in the consolidated statements of operations. 2023, $28 million. 2022, $9.3 million and $6.3 million in 2021. At the bottom of page 87, the company's 2026 senior unsecured convertible notes are carried at face value less unamortized debt issuance costs on the consolidated balance sheets. As of December 31st, 2023, the fair value of the 2026 notes was $142.2 million. The estimated fair value of the 2026 notes are classified as Level 2 financial instruments and are determined based on bid prices of the convertible senior notes in an over-the-counter market on the last business day of the period. And that's it for the notes to the financial statements as far as things I found that were interesting. Next, we go to page 110, which is item 20, subsequent events. Under 2025 notes conversions, between January 1st, 24 and the date this annual report on Form 10-K was filed, the investor converted portions of the aggregate principal of the outstanding 2025 notes of $181.5 million of principal at a conversion price between 1 penny to $1.23 per share into 1,039,773,708 shares of Class A common stock. On January 21st, 2024, the company and the institutional investor that holds the company's 2025 notes entered into a second amendment and waiver agreement, pursuant to which, among other things, the company has secured a release of all liens previously granted to the investor on the intellectual property required by any such transactions. All financial covenants relating to the company's cash reserves were waived, and the company obtained a waiver of the use by the investor of any remaining remedies arising from the company's previous late filing of its quarterly report on Form 10-Q for the quarter ended September 30th, 2023. Under cash on hand, the company had cash and cash equivalents of $53.9 million unrestricted and $11.2 million restricted cash as of April 16th, 2024. Commitment letter for 2024 notes. On March 18th, 2024, the company entered into a financing commitment with an investor providing for the sale of up to $166.7 million in aggregate principal amount of senior secured convertible notes. The 2024 notes will have a 10% original issue discount for gross proceeds of up to $150 million. The 2024 notes will be sold pursuant to a securities purchase agreement and issued in 4 tranches. The first tranche equal to $35 million, and the remaining 3 tranches in equal amounts up to the principal amount. All amounts due under the 2024 notes will be convertible at any time into shares of the company's Class A common stock at a conversion price equal to the market price of the company's Class A common stock as of the SPA closing date, or at the market price of the date of maturity if both elected, and less the original conversion price. The 2024 notes are subject to full ratchet anti-dilution protection and standard conversion rate adjustments upon the occurrence of certain events. The 2024 notes are secured by substantially all of the assets and properties of the company. The 2024 notes will mature upon the earlier of 3 months from the date of the issuance of the first tranche, the effective date of a registration statement for the primary sale of the registered securities of the company, or July 31st, 2024. Interest will accrue at a rate equal to the 3-month secured overnight financing rate plus 12% per annum payable at the maturity date. Next up is Item 9A, Controls and Procedures, page 113. Under Management's report on internal control over financial reporting, management is responsible for establishing and maintaining adequate internal control over financing reporting, in paragraph 1. Third paragraph, management assessed the effectiveness of our internal control over financial reporting as of December 31st, 2023, based on criteria established in Internal Control Integrated Framework 2013, issued by the Committee of Sponsoring Organizations of the Treadway Commission. Based on the assessment using this criteria, management concluded that the company's internal control over financial reporting was not effective as of December 31st, 2023, due to material weaknesses identified below. The company did not design and maintain an effective control environment. 2. The company did not design and maintain effective controls. 3. The company did not design and maintain effective controls in response to the risks of material misstatement over the accounting for inventory and related income statement accounts and revenue and related balance sheet accounts. Specifically, controls over the accounting for inventory and related income statement accounts and revenue and related balance sheet accounts were not sufficient to respond to changes to the risk of material misstatement to the financial reporting due to changes in the business. These material weaknesses contributed to the following additional material weaknesses. The company did not design and maintain effective controls to timely analyze and account for the financial statement effects of variable interest entities and valuation of convertible debt and the related derivative liability. The remediation plan, evaluating skill set gaps and hiring additional accounting, financial reporting, and compliance personnel, designing and implementing controls and processes to facilitate effective communication sharing between departments, designing and implementing a comprehensive and continuous risk assessment process that identifies and assesses risks of material misstatement across the entity, and designing and implementing controls related to the identification of and accounting for certain non-routine, unusual, or complex transactions, including the accounting for variable interest entities and valuation of convertible debt and the related derivative liability. And that brings us to the end, essentially, of the body of the 10K for 2023 for Fisker. The signatures are on page 122, and everything else after that are different agreements, notes, filings, and forms related to the financial statements. And those were my interesting findings in the 2023 Fisker 10K. If you have any questions, please feel free to ask me in the comments below. And yes, I am certain there are key points I missed. Remember, I released this video less than 24 hours, in fact, just barely 12 hours after the document was released. It's all I've done for the last 12 hours. So please take that into account. And thanks in advance. Subscribe for more, and we'll see you on the next one.
Hey! Smash the like button!
Thank you.